Welcome back, everyone. Well, it is the question on everyone's lips today. Will South Africa be downgraded to junk status by Moody's this evening, or will it give us one final reprieve? And has the downgrade been priced in the market? To find out, we will speak to Chris Holdsworth, who is an investment strategist at Investec Wealth and Investment. But first, let's take a look at what it could mean for South Africa if it happens.
We had to do, as you see, as central bankers, you always plan for the worst and you hope for the best. And so what we did was to then stress test the financial system. And we had to then look at three important channels through which a Moody's downgrade, if it was to happen, what it would mean for South Africa. Firstly, it has got implications for the cost of capital in the country. Bear in mind that anybody who wants to lend money to this country, they first start by lending to government, and if there is anything left, then they can lend to everyone else. And secondly, is that with the rising cost of capital, you will then have an impact on investment and through that channel on economic growth. And thus, with an impact on economic growth, you are then going to have an impact on employment. And if you are having fewer people working as a result of that, those people will not be able to service their debt. And if they are not able to service their debt, that fits itself into the banking system, and people would default. And what does that mean for the banking system? So let's go through the first channel, through the cost of capital. Firstly, if we are to be downgraded, we will fall out of the WGBI, the World Government Bond Index. And understand that being in the World Government Bond Index actually reduced our cost of capital as a country, because investors who have to track that index end up buying our bonds just so that they can replicate the index. And as it stands, foreigners own about 38% of our domestic rand-denominated bonds. And that becomes a very important channel. So it becomes important for us to actually be having a macroeconomic settings that are constantly credit positive, because that has got implications for the cost of capital. If that cost of capital goes up, understand that the Constitution says the first charge against the National Revenue Fund is the cost of servicing debt. So you top slice that. So there is less money available for government to spend on other things. Okay? But then that means that everybody else in this economy is going to pay higher for any money that they borrow. It's just straightforward, no conspiracy, just simple economic relationships. With that, the cost of capital of the banks will also go up. And if it goes up, you are going to pay more for your mortgages, for your credit cards, for your car, and so forth. So it is very important that we are rational about how we deal with this. So we said that rise in the cost of capital will thus impact on investment, and if it impacts adversely on investment, you are going to have less growth. And with less growth, you are going to have fewer jobs. I know people would say that, oh, we have had growth, but we have had jobless growth. Well, that's serious rubbish, because this economy continues to create jobs as long as it is growing. There might have been economies that grow and do not create jobs, but I am yet to find one economy that creates jobs and is not growing. It just doesn't happen. So jobs will be shared, and as jobs are shared, we expect that people will not be affording the servicing of their debt, and that will then fit itself into the banking system. We have stress tested the banking system, and we had 3 scenarios, and the most adverse of the scenarios was that this downgrade leads to a protracted decline in economic growth and then feeds itself through those channels that I had described. And if it then happens in that manner for a protracted period, and we took it all the way to 5 years, we still found that the banking system has got enough capital to be able to withstand such a scenario.
Well, of course, as I said, Chris from Investec, Chris Holdworth, the investment strategist there, is joining us to unpack the Moody's decision or expected decision. Chris, thanks so much for your time. I mean, we've just been listening to the governor of the Reserve Bank, providing a bit of comfort, hey, saying that as the bank, they had outlined 3 scenarios, and even in the worst case scenario of a Moody's downgrade, which would result in a protracted decline of South Africa's economy, the banking system would be okay. But just give me your views on this upcoming decision and where you are sitting.
Yeah, first of all, I think the reason the governor can be as confident as he seems to be in the press conference you're referring to is that we've known about this risk for some time. And as a result, the Reserve Bank and the banks have been preparing. And they've been doing their stress tests, and as late as February, we heard that they've done as much as they can do in the event that we are downgraded. The decision for tonight, I don't think is necessarily about a downgrade itself. It's about that change the outlook. At the moment, the outlook is neutral. The risk, typically in an environment like this, is that they change the outlook to negative, and then you get 12 to 18 months before you land up with the downgrade itself. So the question for us is, are we going to see the outlook change to negative? And there, one needs to make reference to previous statements by Moody's. And if you have a look at the ones that came out this time last year, what Moody stated was, if it is the case that the problems in the SOEs were to crystallize to such an extent that the debt to GDP trajectory were to worsen, in that environment, they would change the outlook to negative. And that's pretty much what's happened. So if you read this statement as of last year, there is a risk the outlook's going to negative. However, if you look at the matrix of factors that Moody's typically looks at when determining whether there should be a downgrade or not, and those include dollar GDP per capita, GDP growth, debt to GDP. On that basis, they don't need a downgrade. So it really is a matter of 50-50, but we believe the 50-50 is between keeping the outlook neutral or changing the outlook to negative. We're not forecasting a downgrade itself.
All right, and in fact, many of your peers in the industry, in the market, are also forecasting for the same, a change in the outlook. But I'd like to talk about what has happened since that budget came out in February, where you spoke about the increase in the debt to GDP ratios. The most recent example now, we have had a political, let me call it sort of increased political risk, and this is in the form of a lack of coherent message from government. Just yesterday we heard from the finance minister saying he was not happy with what a state-owned enterprise, SANRAL, had done in its decision not to pursue historic debt of the e-tolls. We have heard from the deputy president of this country saying that, in fact, you know, in short, he doesn't always take what the finance minister says seriously. We've even heard from the president on one hand talk about nationalization of the Reserve Bank, and on the other hand saying that the Reserve Bank's independence is sacrosanct. So this sounds like a lot of mixed messages for me. And I mean, if you're Moody's and you're looking at this incoherent messaging from government or this lack of unity, how confident are you that this government can actually commit to some of the policy decisions that it says it will?
That's a very fair point, because the basis for their decision is going to be on background conversations that they've had with government. And if they have little faith in the ability of government to follow through on the commitments they make in those discussions, then surely that would raise question marks. But it's more than that as well, because the market has taken cognizance of all the uncertainty that's out there. The market isn't just pricing in a change in the outlook. The market is fully discounting the fact that we are going to get downgraded. If you look at the cost of debt for the South African government, It's well above that of Brazil, which is rated worse than South Africa. It's well above Russia, which is rated the same as South Africa, according to Moody's. So this uncertainty is not just the uncertainty, it's actually the bad news that's come before that as well. It is fully reflected, and perhaps that is the opportunity. The market isn't saying there's a possibility at all that the outlook remains at neutral. And if that is the case, it would be very well received, notwithstanding the uncertainty that you've made reference to.
Right. I mean, this feeding into what the governor of the Reserve Bank said yesterday about the rand being less undervalued than it was before. So if a decision by Moody's to change the outlook to the sovereign is already priced in, are you saying that when that decision actually comes out, we shouldn't expect much action on the currency, we shouldn't expect much action on equities, particularly those that are South Africa facing?
Yeah, so the first thing we're expecting to come after the close, so we wouldn't see an immediate move in the equity market. There may be something brief in the currency, but we're not expecting it to last more than a day or two. That is if they change the outlook to negative, because it is what is broadly expected. If they were to downgrade straight away, and with that come caution of further downgrades, that's a different story. That's not what we're expecting, and I don't think that's what the market expects. But if they simply change the outlook to negative, saying these are the things that we expect, we have caused a risk, highlighting Eskom, of course, and say we've given 12 to 18 months, and if the situation deteriorates much further, then we will downgrade fully. I think that scenario is fully priced in, and we shouldn't expect much of a move if that is what comes. But then
does the change in the outlook impact in any way the risk or the cost of doing business in South Africa? So my question is, are we likely to see investors such as yourself or companies looking for money to do business here having to pay a higher cost to service that or get that money because of the change of outlook?
I would say no, because the downgrade has happened already in the market. Our long bond yield is, let's say 10-year bond yield, is sitting at just over 9%. Inflation at the moment is 4%. Let's say it's going to move to 5%. The Reserve Bank expectation is for inflation to go up. So you're looking at a real yield at the long end of the yield curve sitting at about 4%. There are very few countries in the world that have that. And they are emerging markets. It is the sort of countries like Brazil and Russia. The concern about the increase in funding is after the horse has bolted, it's happened. We need to be looking forward as to, is that going to get much worse? And that would require further downgrades below junk, actually. Or at some point, is it going to improve? But the bad news is already fully discounted.
Okay, Chris, it sounds like you are describing a business as usual scenario then after this ratings announcement later today.
Well, we have to do our best as government or as South Africans to ensure that we don't end up getting fully downgraded. Because once you are in that bottom rung and you have been downgraded, the history suggests it takes a long time to turn around. So then the concern isn't just that it's priced in now, but that it's going to be priced in for the next 5 years. And that's where the opportunity lies for the state. I mean, we have to accept the cost of funding is high now, but presumably the goal is to get that reduced in the next few years, which means you have to make every single effort you can to avoid a downgrade 12 to 18 months down the line.
Well, Chris, thanks so much for those insights. Enjoyed them thoroughly. That was Chris Holdsworth, who's an investment strategist at Investment Wealth and Investment.